News alerts flash across phone screens. The U.S. Securities and Exchange Commission files lawsuits against major crypto exchanges. Market prices drop within minutes. Crypto founders go on podcasts, calling it an attack on innovation. The SEC chair says, most crypto tokens are securities. The industry responds, this is regulation by enforcement. Investors are confused. Startups are nervous. Lawmakers are divided.
I don't see a way for us to regulate them all. I do think there's...
And in the center of this storm is one man, Gary Gensler. Some people say he tried to protect investors. Others say he tried to crush crypto. So what really happened? Was this a war on crypto? Or was it the moment crypto grew up? To understand that, we need to go back to the beginning. Who is Gary Gensler? Gary Gensler is not a typical regulator. Before leading the SEC, he worked at Goldman Sachs for nearly 20 years. He understood Wall Street from the inside. Later, after the 2008 financial crisis, he became chairman of the Commodity Futures Trading Commission, also known as the CFTC. There, he helped regulate the derivatives market and pushed for stricter rules after the financial meltdown. He built a reputation as a tough regulator. But here's the surprising part. Before becoming SEC chair, Gensler taught blockchain technology at MIT. Yes, he literally taught classes about Bitcoin, Ethereum, and decentralized finance. His lectures explained how Bitcoin mining works, how smart contracts function, what makes tokens different from stocks, why blockchain technology could change finance. He was not someone who ignored crypto. He studied it carefully. So when President Biden nominated him to lead the SEC in 2021, many people in the crypto industry were hopeful. They thought, finally someone who understands us. But understanding something does not mean supporting it without limits. The SEC's role and the law. To understand the conflict, you need to understand the SEC's job. The SEC was created after the Great Depression. Its mission is simple: protect investors, maintain fair markets, reduce fraud. The main tool the SEC uses is something called the Howey test. This test comes from a 1946 Supreme Court case. It helps decide whether something is a security. According to the Howey test, something is a security if 1. People invest money; 2. in a common enterprise; 3. expecting profits; 4. based on the efforts of others. If an asset meets these 4 points, it is legally considered a security, and securities must follow strict rules. Registration, disclosure, transparency, investor protection requirements. Gary Gensler believed many crypto tokens met this definition. The crypto industry strongly disagreed, and that disagreement started a major conflict: the Ripple lawsuit. In December 2020, just before Gensler became chair, the SEC sued Ripple Labs. The SEC claimed Ripple sold XRP as an unregistered security. This case became extremely important. If XRP was ruled a security, it could affect hundreds of other tokens. The crypto community watched closely. Some parts of the ruling later gave partial victories to both sides. It showed how complicated these cases were. But the message was clear. The SEC was willing to go after major crypto companies, and that was only the beginning. Actions against exchanges. After Gensler officially took office, enforcement increased. The SEC took action against large crypto exchanges, arguing that some tokens listed were unregistered securities. Some platforms operated as unregistered exchanges. Certain lending and staking programs were securities. The SEC also charged companies for offering staking services without registration. Staking, in simple words, allows people to earn rewards by helping secure blockchain networks. The SEC argued that when companies pool customer funds and promise returns, it can look like an investment contract. Crypto companies responded, "There are no clear rules for us to follow." This is where the phrase regulation by enforcement became popular. Instead of writing new crypto laws, the SEC applied existing securities laws to digital assets. From the SEC's perspective, new laws were not necessary. From the industry's perspective, crypto was being forced into old frameworks that did not fully fit: stablecoins and DeFi pressure. The SEC also looked closely at stablecoins, digital tokens designed to hold steady value, often tied to the US dollar. Concerns included whether reserves were fully backed, whether investors had enough transparency, whether stablecoins could create systemic risk. Decentralized finance, or DeFi, also faced questions. If a platform has no central company, who is responsible? If something goes wrong, who protects investors? These questions had no easy answers, but the SEC's focus remained consistent. Investor protection comes first. Industry pushback. Crypto leaders argued that innovation was being pushed overseas. They said startups were moving to countries with clearer crypto regulations. The US risked falling behind in financial technology. Some members of Congress criticized the SEC's approach. They argued that crypto needs tailored legislation, clear rules should be written before punishment, enforcement without guidance creates confusion. However, others in Congress supported strict oversight.
Chair Gensler, you've publicly stated that, and I quote, "Our markets are the finest in the world," and that, quote, "retail..."
They pointed to crypto collapses, scams, and bankruptcies that harmed investors every day. Major failures in the crypto space made the debate even stronger. Were stricter rules needed, or was innovation being slowed down? The Bitcoin ETF battle. For years, the SEC rejected applications for a spot Bitcoin ETF. A spot ETF allows investors to buy exposure to Bitcoin through traditional stock markets. The SEC said the Bitcoin market was vulnerable to manipulation. Crypto companies challenged those decisions in court. Eventually, legal pressure increased. And finally, in 2024, spot Bitcoin ETFs were approved.
Approved for the first time. There we go. U.S. regulators have given the thumbs up to these ETFs that invest directly in Bitcoin.
This was a major turning point. Large institutions could now access Bitcoin through regulated financial products. Billions of dollars flowed in. This created a paradox. The same regulator accused of attacking crypto ended up overseeing its biggest step into mainstream finance. So, was the SEC anti-crypto? Or was it trying to bring crypto inside the traditional financial system safely? The bigger picture. Maybe this was never about personal hostility. Maybe it was about two systems colliding. Crypto was built on decentralization. Traditional finance is built on regulation and oversight. Crypto values freedom and speed. Regulators value stability and protection. When those two worlds met, conflict was almost guaranteed. Gary Gensler became the face of that collision. To some, he slowed growth. To others, he prevented larger disasters. Crypto's first decade was about proving it could survive. It survived crashes, it survived skepticism, it survived bans. The second decade is about something different. Integration. Can crypto operate inside global financial systems? Can it follow rules without losing its identity? Gary Gensler's time at the SEC will be remembered as a defining chapter in that story. Whether history sees him as a barrier or as a builder of long-term legitimacy is still undecided. But one thing is clear, crypto is no longer operating in the shadows. It is being regulated, it is being debated, and it is being tested. And that story is still being written. So the real question is not whether the SEC fought crypto. The real question is, what kind of crypto industry will survive this era of regulation? If you found this breakdown helpful, make sure to like the video and subscribe for more deep dives into finance, regulation, and the future of digital assets. And let me know in the comments, was this protection or pressure? I'll see you in the next one.